Ladies and gentlemen, it is time. We have talked about the spread several times during this course. It is time to see in detail what it is. When you see a currency pair quoted by a broker, you'll immediately notice that there is not just one price. The currency pair will be shown with two prices, the bid price and the ask price. Euro-dollar will look something like this, 1.10505 and 1.10510. The first price is called the bid price and the second is called the ask price. In order to understand why we have two prices, we need to introduce the order book. What is an order book? Traditionally, it was a physical book in which banks and brokers registered the orders from all their clients. Today, everything is electronic, but we still refer to it as order book. So let's say that you are looking at euro-dollar, for example. Just like you, millions of traders around the world are looking at it and placing orders. All these orders are stored in the broker's order book. To keep it simple, let's say that there are only three orders to sell. One is at 1.10505, one is at 1.10540, and another one is at 1.10556. Now, as a buyer, you want to choose the lowest price available. So if you had to buy euro-dollar, you will buy it from the guy selling it at 1.10505, which is the lowest price available at the moment. Same goes if you want to sell the currency pair. Let's say that there are three buyers around the world. One is offering to buy at 1.10510, another one is offering 1.10450, and another one is offering 1.10415. As a seller, you want to sell at the highest possible price, so you want to choose the buyer offering 1.10510, which is the highest price available at the moment. So the broker has one order book with all the offers to buy and one order book with all the offers to sell. These are likely to be hundreds of thousands, if not millions of offers, but the ones that the broker shows you, so the ones that you see on your trading platform, are the best offers available at that time. So if you see that the price is 1.10505, 1.10510, it means that from their order books, the best price that the broker can offer in case you want to buy is 1.10510. The best price they can offer in case you want to sell is 1.10505. So the bid price is the price at which a trader can sell the currency pair, while the ask price is the price at which a trader can buy the currency pair. So if you want to buy euro-dollar, you will get a price of 1.10510. If you want to sell the pair, you will get the price of 1.10505. There is a difference of half pip that is called bid-ask spread, and it represents a commission that you pay to trade in the forex market. Let's say that you want to buy euro-dollar and the broker is quoting it as follows: 1.10805 for the bid price, 1.10810 for the ask price. Which price will you get? You want to buy, so you will get the price of 1.10810. After 30 minutes, the price is 1.11205, 1.11210, and you decide to sell your position on euro-dollar. Which price will you get this time? You will get the price of 1.11205 because you want to sell your position. In order to understand why the spread represents a cost for you, let's say that you buy euro-dollar and then immediately sell it. You buy it at 1.11210 and you sell it at 1.11205. You lost half a pip. So you buy with the ask price and you close the buy position with the bid price, and the difference between them is called the bid-ask spread. This is true of a long position, but what about a short position? Remember that a short position is just the opposite of a long position. With a long position, you buy the currency pair and then you sell it. The process for a short position, although it may sound counterintuitive, is just the opposite. You sell it first and then you buy it. So if you want to open a short position on euro-dollar, what price will you get? You will get 1.11205, which is the price at which you sell. When you want to close your short position, which price will you get? You will get 1.11210, which is the price at which you buy. Later on, we are going to spend some time on the trading platform called MetaTrader 4, and we are going to have plenty of examples. But for now, I just want to show you what the buy-sell window looks like when you try to open a new trade. The sell price is always on the left and the buy price is always on the right. The sell price is never higher than the buy price, but sometimes they are the same, which means that if you open your position now, you pay no spread at all. This is a particularly good broker when it comes to spread, so it's quite normal to see the spread being around zero. I'm going to share with you a list of good brokers you can choose from, so don't worry about it right now. Another thing you can notice from this window is that the price continually moves and the spread is not constant. The spread varies depending on several factors, with liquidity being the most important one. As a trader, it's important to keep your costs as low as possible in order to be successful. One of the costs you need to manage is the bid-ask spread. A narrow spread is ideal because it means you're paying less to enter and exit a trade. Generally, the spread is lower when the liquidity is large, so what factors usually contribute to a larger liquidity and so to a narrower spread? It's time to see if you have been a good student or not. Take a few minutes to think about it. You can also pause the video. There are two factors we have already studied in this course. The first one is major currency pairs tend to have a higher liquidity than minor or exotic pairs, so they often have narrower spreads. The second one is that the London and the New York sessions generally have more transactions, so a higher liquidity, which can also result in narrower spreads. I want to offer you three different scenarios. Can you rank them in terms of minimizing the cost of the spread? In the first scenario, we have a trade on Canadian dollar against Swiss franc right when the New York session ends. In the second scenario, we have a trade on euro dollar during the overlap between the London and the New York sessions. In the third scenario, we have a trade on pound against Japanese yen during the last hour of the London session. Which one is the best scenario to minimize the cost of spreads? Which one is the worst? And can you rank them? The best scenario is the second one. We have a trade on a major currency pair during a time of the day that usually has very high liquidity. The second place goes for the last scenario presented, in which we have a minor currency pair during a time of the day in which we still have good liquidity. The worst scenario is the first one, in which we have a minor currency pair during a time of the day in which liquidity is very low and spread is usually quite large. So, as you can see, it's nothing too complicated. It's just a matter of applying what you have learned so far in this course. By being mindful of these factors, you can potentially save money on bid-ask spreads and improve your overall profitability as a trader.